Hello and welcome to Within the Frame. I'm Han Da-eun in Seoul. The Bank of Korea kept the base rate steady at 3.5%, extending its rate freeze for the 13th straight time. All members of the Monetary Policy Board agreed on the rate freeze, with some leaving room for a rate cut within the next 3 months. It also revised down Korea's growth forecast this year from 2.5% to 2.4%. This as Korea and the world await more clues from U.S. Fed Chair Jerome Powell, who's expected to address global central bankers at the upcoming Jackson Hole Symposium. For deeper economic insights into these developments and what to expect going forward, Kim Sei-wan, professor of economics at Ewha Womans University, joins us via Skype. It's always a pleasure to have you with us.
Thank you for having me today.
And joining us from Hong Kong is Trinh Nguyen, senior economist at Natixis. Thank you, as always, for being with us.
Thank you very much.
All right.
It's a pleasure.
Professor Kim, let's start off with you. So the Bank of Korea kept its benchmark interest rate steady. What are the key factors behind the decision that we should know about?
As you said, Bank of Korea has decided to leave its key interest rate at current level of 3.5% today. But actually, there were rising market expectations on Bank of Korea's interest rate cut today by 0.25%. For example, KDI, government's think tank, suggested before a preemptive interest rate cut in August. They argued that domestic consumption and investments are weakening due to higher interest rate. So I'm pretty much sure that Bank of Korea will cut its base interest rate by 0.25% in October after seeing U.S. Fed's interest rate cut in September. Related to interest rate cut, Bank of Korea believes that lower interest rate in Korea could trigger an unstable financial market by raising mortgage loan. Also, lower interest rate destabilized foreign exchange market by raising $1 exchange rate. The higher $1 exchange rate can be another pressure to raise domestic price level by increasing importing prices.
So you expect the Bank of Korea to start cutting rates sometime in October following the U.S. Fed's rate decision. But the Bank of Korea is deeply concerned about the risks stemming from rising housing prices and household debt. So it looks like we won't be able to see a rate cut until the BOK has conviction about those risks, which leads us to our next question, Professor Kim. BOK Governor Lee Chang-yong held a Q&A session with the press, touching upon various subjects from the government's real estate policy to domestic spending. What are some key points that caught your attention?
Well, Bank of Korea is under difficult situation between curbing household loan and recovering economy. Governor Lee talked much about this difficult position of Bank of Korea at the Q&A session after deciding the interest rate leave as it is. From the first quarter of this year, household loan is increasing quickly due to rising housing prices. In July, household loan increased by 5.5 trillion won. The balance of household loans at the 5 major commercial banks stood at about 720 trillion won as of this month. For restricting household loan, all major banks are raising mortgage rates. For example, Shinhan Bank, one of the largest banks in South Korea, raises mortgage rates by up to 0.5% last week, which was 5th increase in a month. And all other commercial banks are following this raising in mortgage interest rate. But at the same time, the biggest factor hindering economic recovery in Korea is the weak domestic demand due to higher interest rate. Both of households' consumption and corporations' investments are declining compared to last year as higher interest rate continues. But as we have seen from previous report, as the policy focus shifts toward economic recovery this month and next month, Bank of Korea will cut its rate in the next meeting in October to stimulate domestic spending and recovering economy.
The Bank of Korea basically reined in the housing market, saying it's trying hard to stop the rise and avoid exacerbating the drag that household debt puts on long-term economic growth. And as you pointed out, sluggish domestic demand is another big factor that's dragging down Korea's overall economy. Now, Trinh, the Jackson Hole Symposium, a gathering of central bankers worldwide, will kick off tomorrow. And much attention, obviously, is drawn to U.S. Federal Reserve Jerome Powell's speech. What clues would he provide about U.S. rate cuts?
Well, I think for many people, the weakness of the labor market, and particularly after the BLS downward revision by roughly almost 1 million jobs, point to the fact that the U.S. economy is softening. But the question is, how worried should he be about this? And I think, there's a 100 basis point price in, which means that we're going to need one jumbo hike of 50 basis points, or the rates market would have to reprice its exuberant expectations of the U.S. economy. So it's going to be very important, the tone that he sets, how dovish he is. So far, markets have read much of everything that's happened in the past week as relatively dovish, from the minutes to the Fed speakers to the data. So if he wants to push back rate cut expectations, he will need to adopt a much more cautious tone, I would imagine. I do think that the Fed is going to follow very similar to what the RBNZ already did, which is to start with 25 basis point hike and wait for data dependency. We have softening of gains of the U.S. jobs. We are not yet seeing layoffs and contractions and signs of recessions. What's very clear is that real interest rate is high, so some softening is expected. It's a question of whether or not we're going to get the Goldilocks scenario, which is the economy slowing, but at a very decent level, and enough for the Fed to cut rates substantially. And I think something has got to give, and I think very likely what's going to give is really Jerome Powell trying to push back some of this short-term rate cut expectations.
So inflation and job market data, as you pointed out, will be the key in deciding the timing of the U.S. rate cut. But what about external factors? What outside variables may impact the U.S. Fed's monetary policy?
Obviously, commodity market, supply chains, disruptions, geopolitical risk, financial conditions. For example, we have a railway strike right now in Canada. But generally speaking, if you look at most of the inflation in the U.S., it started with goods inflation driven by supply chain disruption, and then translating to services, right? So many of those factors were quite external. So that's going to be quite important. But most of the issues in the U.S. are generally quite domestic driven. And the second factor, of course, is that for us to really get these aggressive rate cut price in for 2024, you will need severe contraction of the economy, or you can say that financial instability, and that could be driven not necessarily by the U.S. As you can see what happened with the BOJ and how that unwinding of the yen carry trade can really destabilize. That obviously got quickly pushed away as people realize that there's no recession in the U.S., but financial instability is another factor to look out for. But all in all, we don't think these things are going to be, in the short term, be quite significant. I think U.S. data itself is going to be quite important. Commodity prices have come down. U.S. data in terms of U.S. inflation, U.S. The data in terms of underlying growth numbers will be very key for Jerome Powell. And I think what I think is going to really happen is that he's going to wait for significant deterioration of data, right? You can always start with a jumbo cut later. You can start very gradually, right, with 25 basis points. If need be, it could be 50, aggressively to 75. If he makes a policy mistake of cutting when inflation could potentially spike for a number of reasons, for the reasons I mentioned, geopolitics is one, geopolitical disruption, climate change. You can have just a bad yield on agriculture harvest, right? That could be hugely impactful. Droughts can impact the Suez Canal and so on and so forth. right? So I do think that he's going to strike a very cautious tone and use words such as data dependency and mostly U.S. data at the moment.
Professor Kim, amid increasing global oil price volatilities, the Korean government has extended fuel tax cuts for another 2 months. Consumers will get a 20% deduction on gasoline and 30% on diesel and LPG until October 31st. Would this help in stabilizing prices?
I believe so. Even though inflation pressure is pretty much weakened at 2.6% on year in July, Korean government will maintain the reduction in fuel taxes to strengthen price stability. The Ministry of Economy and Finance announced that considering the uncertainty in domestic and international oil prices due to tensions in Middle East and domestic inflation trends, it plans to extend the reduction of fuel tax flexible rate until October 31st. Actually, Korean government expanded the fuel tax reduction for gas and diesel to 37% in July 2022 to stabilize prices. But in 2022, we need to remember that inflation level almost exceeded 6% on year. However, starting this year and last year, the reduction for gas was scaled back to 25%, and the sunset deadline for this measure has been extended since then. But I believe that this fuel tax reduction will be discontinued sometime early next year, 2025, to save Korean government's tax revenues.
What's your inflation outlook for this year?
Well, inflation will be pretty much stabilized for this year. As we talked about, the most recently updated inflation rate is about 2.6%, and 2% annual inflation rate is under the government's inflation and Bank of Korea's inflation target. But as Korean economy is weakening this year, we can expect that the inflation rate will be decreased down to 2.5% in 2024.
The BOK also seems quite confident about cooling inflation. It projects inflation to continue to slow down the road this year, staying in the 2.5% range. Now, Trinh, gold prices have hit a fresh high with a standard gold bar now worth more than $1 million. What's driving gold prices to new heights?
Demand, more buying from central banks, more buying from individuals in terms of actually physical gold. I think the fact that there are two reasons for it. You can think of it as geopolitical risk. Risk can spike to impact financial markets, but geopolitical risks are simmering in the background. You have Ukraine, Russia. You have the Middle East, and also within Asia, it's also simmering, right? So as a result, that people are not very confident about the current global order can be sustained, and there's a lot of uncertainty. Gold can be seen as a way to hedge some of that. Gold obviously provides no yield, and it actually physical gold has a storage cost, but it doesn't have counterparty risk, such as, for example, digital currency that people have invested in some of the brokerages have gone under the latest. And the second thing is, of course, the fact that yields for the US dollar have come down. The fact that gold has no yield, it's being helped, right? So overall, much of it is due to demand to hedge, and demand for physical assets, particularly gold, which actually is much smaller than buying, for example, a physical asset such as a house, and due to the fact that we have a lot of geopolitical uncertainty, and so as a result, gold prices have surged quite substantially. Now, I think part of it is also driven by the buying in China. Traditionally, it's driven by fundamental demand for cultural reasons, such as India. But in China, the fact that the stock market continues to be quite weak, the bond market, after rallying, is being suppressed by the government. And of course, the real estate market is recovering, is very sluggish. So as a result, you have a lot of physical demand for gold, right? And I think with geopolitical tensions and uncertainty about the future, demand will remain quite robust, especially as yields on the dollar decline.
So global banks, as well as individual investors, more of them place their bets on gold amid various factors, including rising geopolitical tensions. And Trinh, how long would the dollar slump continue, and how would it impact global currencies, including the Korean won?
Well, there's a lot of pricing right now for rate cuts, right? One of the reasons, and this is something that I repeatedly say, that a lot of the rallying of the Asian currencies, including the Korean won, but most importantly, the ASEAN currencies like IDR, Malaysian ringgit, the Thai baht, and so on and so forth, is driven by the dollar, right? The BOK didn't cut. It's really the massive pricing and the repricing in of cuts for 2024 and 2025, right? So the question is, can we have further rallies? Yes, if we have significant weakness of U.S. data, right? So for example, if somehow, as I mentioned, it's all very much about data dependency. If you have significant weakness of the U.S. data, you can have markets pricing in much more rate cuts. Is that very likely? Probably not. But that can happen. So the dollar, in my opinion, in the short term seems quite strong, quite too weak in the moment. Meaning, I do think that unless the data comes out surprisingly very weak in the short term, the next several months, you can see the dollar strengthening a bit. So, for example, today, after the dollar weakening significantly, today the dollar rally a bit, just because people are quite cautious on what kind of tone the U.S. Will strike, the U.S. Central Bank will strike. But beyond the tone, I do think the data itself will be quite important. So for now, the dollar in terms of a longer term trend has peaked because we're starting our descent of U.S. dollar rates. The big uncertainty, I do think, is where both the short end and the longer end, and I do think that there's a bit too much exuberance in terms of rate cuts expectation in 2024. 2025 seems a bit about right, but beyond that, even 2026, right? So there's a lot of repricing that can happen, so a lot of volatility that could happen in the short term, but the dollar does look a bit oversold in the next several months.
Professor Kim, the Bank of Korea lowered this year's growth outlook for Korea from 2.5% to 2.4%. What insights can we draw from this?
Basically, the updated lower economic growth forecast confirms Bank of Korea's interest rate cut in the next meeting in October. Considering the unusually high growth rate of 1.3% in the first quarter, Bank of Korea's annual forecast was significantly revised upward from 2.1% to 2.5% in May. However, just 3 months later, expectations for Korean economy has been slightly lowered. So it needs to be noted that Bank of Korea's expectation on Korean economy early this year was too much positive compared to the reality of today. Bank of Korea says in their report released today that the volatility in financial markets has increased and geopolitical risks have been escalated. The Bank of Korea's latest projection of 2.4% economic growth is lower than not only the government's and the OECD's forecast of 2.6%, but also the projections of 2.5% from KDI, government think tanks, and International Monetary Fund, or IMF.
And the BOK unveiled its quarterly projections for the first time, which is expected to act as the dot plot of the U.S. Federal Reserve. Could you elaborate on what role the BOK's new quarterly projections will play?
This revised economic outlook marks the first time the Bank of Korea has released quarterly economic forecast figures. Previously, they only disclosed semi-annual or 6-month and annual forecast, while the quarterly figures were used internally. So the quarterly forecast was something like a secret of the Bank of Korea so far. This is the first time Bank of Korea making its internal data available to the public. The market has positively, of course, estimated the Bank of Korea's release of quarterly economic forecast, particularly in terms of economic analysis, information sharing. The significance of this move lies in the fact that the differences between the Bank of Korea and the market in economic forecast could be identified, not just in terms of information sharing.
All right, we'll leave our discussion there. Thank you, as always, Professor Kim, for sharing your thoughts with us today.
Thank you very much.
And thank you, Trinh, for your in-depth analysis.
Thank you very much.
And that brings us to the end of the show. Thank you for watching, and be sure to tune in same time tomorrow to join our conversation. Goodbye for now.